politicians. Everything he's doing is political. The economy takes a back seat to reelecting the incumbent party, which is the Democrats, which is Biden. And so everything Powell is doing, the goal is to reelect Biden. Hopefully the public won't allow him to achieve that goal. I mean, looking at the polls, it looks like he's going to be a one-termer.
Famous investor and economist Peter Schiff expressed his concerns about the state of the U.S. economy, stating that no one is benefiting from the current state of affairs and that changes must be made to stop more crises. He went so far as to claim that the measures taken by the Biden-led administration weren't functional. In this video, I will review Schiff's reasons for this statement and much more. Let's get started. Peter Schiff stands out as a notable figure in the realm of investments. After successfully predicting the 2008 financial crisis, his acclaim soared. Since then, he has emerged as one of the best critics of the Federal Reserve's monetary policies. Schiff's forecast may spark controversy, but he aims to prevent a financial downturn. With the U.S. battling with inflation and its related crisis for several months now, Schiff predicts the situation and where exactly the nation's economy is heading as usual. According to the latest non-farm payroll report from the Bureau of Labor Statistics, the U.S. economy added 199,000 new jobs in November, and the unemployment rate dropped to 3.7%. CNBC also reported that the unemployment rate has declined due to increased job creation. They even provided a graph of monthly job creation in the state to provide more insight. So this employment data portrayed that the economy is easing toward a soft landing and isn't on the brink of recession as we all think it was. Most mainstream pundits characterize the November job report as a Goldilocks, which wasn't strong enough. Let's look at this video to get a better understanding.
Those job numbers, despite the fact that the Biden administration and a lot of other people want to make a big deal out of all the jobs that were created, these are jobs that people don't want. These are second jobs. These are third jobs. These jobs exist because people can't survive on one job anymore.
The job growth was strong enough to support the soft landing narrative, but not so strong that it might scare the Federal Reserve into raising interest rates again. Either way, Peter Schiff isn't impressed a little. In his words, the job report is only hyped up. He even accused Biden of being at fault. After all, he was in administration. President Joe Biden used the report to boast about his economic achievement during a White House briefing. In addition to the 199,000 jobs in November, he has created over 14 million jobs since taking office. According to Biden, that's more than 14 million additional Americans who know the dignity and peace of mind that comes with a paycheck. The unemployment rate has remained below 4% for 22 months. And inflation has fallen by 2/3. After adjusting for inflation, workers' paychecks and household wealth are higher now than before the pandemic. The Federal Reserve Board reported that the real median net worth surged to 37%, while the real mean net worth increased by 23% between 2019 and 2022, which is evident in this graph. But according to Peter, Biden doesn't have anything to boast about. In a recent interview on the Capitol Report on NTD News, he revealed that, after the job report was released, Biden said, "Under my watch, we have achieved better growth and lower inflation than any other advanced country." Meanwhile, forecasters said it couldn't be done a year ago. Regarding Biden taking credit for the strong economy, Peter said he doesn't think there is anything for the president to take credit for. Those jobs aren't actual jobs. Let's hear it from Peter.
If you look at the, 199,000 jobs, 24% of those jobs were just striking auto workers or, motion picture workers going back to jobs they already had because they settled their strike. So that's not really job creation.
They aren't productive. No exportable or consumable goods, whereas those workers will be paid. Gold has always been the world's safest haven. It stood as the #1 amidst insecurity, war, economic or political turmoil, and lots more. and that has been for over 5,000 years. Gold started its current bull market in 1971 and began trading in the free market. Since then, it has been soaring, as shown in this graph. That's why the expert economist said we should all go for gold, as the economy will only worsen. Let's hear it from him.
Well, I think if people really understood just how bad it is and how much worse it's going to get, they'd be buying a lot more gold. Because inflation is a huge problem and it's only going to get worse. The talk of the Fed successfully returning inflation to 2%, that's all talk. It's not going to happen.
According to Peter, the recession would have happened a long time ago if not for the bailout when large U.S. banks injected $30 billion in deposits into First Republic Bank to rescue the lender caught up in a widening crisis triggered by the collapse of two mid-sized U.S. lenders due to the increasing interest rate. The gold bug went to his social media platform, where he made some gloomy predictions about the nation's economy. He wrote that the U.S. dollar is on the verge of a historic crash, becoming a real game changer as it will send inflation, interest rates, and unemployment over the ceiling. To Schiff, the economy is far from a soft landing. Crash and burn suits such a situation. He added that the U.S. dollar is a toast, and the only way out is to invest in gold. He explained that the U.S. economy is already in recession. Although Q3 GDP grew by 5.2%, government spending is responsible for 5.5%. This graph provides a pictorial explanation. Meanwhile, this government spending doesn't reflect real economic growth. It only leads to higher inflation. The nation would surely be thrown into a frenzy with this prediction, so we need to fact-check. The latest inflation data from the Bureau of Labor Statistics isn't good. The data said that overall prices for urban consumers rose 0.1% in November compared to October. According to the chief economist from Comerica Bank, gas prices fell in late 2023 as domestic oil production hit a new record high. However, the price of food and shelter also rose due to inflation. David Wald, the managing advisor of Lux Wealth, also said the Fed would leave the rates unchanged because they have been raised quickly, as he mentioned in this video.
They're going to leave the rates unchanged just due to the fact that we raised the interest rates so fast in such a short amount of time that those rate hikes are still working themselves through the system.
Inflation peaked in June 2022 at more than 9%, the highest inflation level in more than 40 years. It even exceeds the 2% inflation target by a wide margin. According to Schiff, the government wanted a 2% inflation, so when it resulted in excess, they should also welcome it. However, the Department of Labor reports that CPI drops to 3.1% year-over-year in November. That is from a 3.2% increase in October, and in line with many economists' estimates. The CPI is up 0.1% monthly, which also aligns with economists' estimates. The November CPI reading, as shown in this graph, is the latest indicator the Federal Reserve is making progress in its ongoing battle against inflation. The easing of inflation appears to be directly related to the Federal Reserve's decision, beginning in 2022, to raise the primary interest rate it controls, the Fed funds rate, for the first time since 2018. By July 2023, the Fed had hiked the target Fed funds rate to a range of 5.25%, 5.5%, up from near 0% before rate hikes began. It's the highest level for the Fed funds rate since early 2001. The Fed also ended its bond buying program and began reducing its bond holdings. The Fed aims to slow economic growth to help reduce inflationary pressures. For the most part, the Fed appears to have succeeded in its mission. Yet, core inflation, living costs excluding food and energy sectors, and wage costs remain higher than the Fed's target. The Fed has indicated it will at least maintain higher interest rates for an extended period. In response to the Fed's aggressive interest rate hikes, yields on many fixed-income vehicles, such as certificates of deposit and bonds, rose. Mortgage rates and interest charged on other types of financing, such as credit card debt and automobile loans, also increased. The changing interest rate environment had its greatest impact on areas of the economy, such as the housing market. Activity slowed due to increasing mortgage rates, which neared 8% in October 2023, the highest level in over 20. Home prices declined briefly, but then recovered. The combination of rebounding home prices and higher mortgage rates makes housing affordability a bigger concern. Let's hear what Peter has to say here.
Why this is a bigger financial crisis now than in 2008, it's the banks are losing money on all the mortgages, even the mortgages where people are paying. Back in 2008, it was only the defaulted mortgages that were a problem. Now all of them are a problem.
A key question is whether the Fed's aggressive policy could successfully end inflation and provide the country with a soft landing, or the crash Schiff is talking about. Contrary to Schiff's claim, Matt Shopner, senior economist at U.S. Bank, said it seems likely that the economy might avoid recession in the near term. However, the real GDP growth will remain modest over time. According to Matt, it can be called a growth recession, where we see a slow economy but with little influence on the job market. Also, much of the positive momentum in the closing months of 2023 has likely been fueled by expectations of a Fed pivot to rate cuts sometime in the first half of 2024. Fed Chairman Jerome Powell kept interest rates steady at the last FOMC meeting this month, making it the third policy meeting that saw interest rates unchanged. And while Powell acknowledged that any reversal in current inflation trends could spark the Fed to resume its interest rate cuts, more of the talk was focused on rate cuts. Let's hear it from Powell's mouth.
To leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come,
the median projection among Fed members regarding where interest rates will be at the end of 2024 fell to 4.6% from 5.1% in September. That means the Fed expects to cut interest rates by 25 basis points at least thrice in 2024. Schiff hasn't failed to remind the nation about the fall of the US dollar. As of October, he claimed that the dollar would fall, pulling the economy and American living standards. He also mentioned that anyone holding dollars would face significant losses. A month before making this announcement, he had said a massive crisis would occur, leading to the early exit of the US dollar. He even reiterated his warning about the impending collapse of the currency during an interview with David Rodriguez, replying to a question about whether everyone is escaping the US dollar. Here's what Schiff said.
And everyone's leaving the dollar, correct? Everyone's escaping the dollar.
They will be. I mean, right now it's, just kind of like a trickle.
He predicted that the interest on the debt would be the government's biggest expense by next year, and it eventually ends up being the only expense the nation tends to. But if it continues, there won't be any money left over for anything but interest. Let's take a look at one of his posts on Twitter.
Due to a weak economy and rising rates, the national debt is over $33.7 trillion, an increase of $700 billion in just over 6 weeks. At this pace, the national debt is growing in excess of $5 trillion per year, despite official deficit projections of under $2 trillion annually. You just can't keep spending more than we bring in, printing money, and doing what they're doing within the Biden regime.
Schiff mentioned that we obviously couldn't reach that point because there would have been a massive crisis long before we arrived. It's surely going to send the economy into a crash. He also noted that many countries worldwide are ditching the US dollar and using national currencies in international trade, such as the BRICS nations. They were awakened when the US froze Russia's dollar reserves due to the war. Peter seems on point here, but he has gone to the extreme, as others claim. The dollar index fell to its lowest over 2 months, as investors believe the US Federal Reserve has completed its interest rate hike cycle. According to a recent post on Reuters.com, the dollar index hit a low of 103.37, its weakest level since Sep1, after a tumble of nearly 2%, marking the biggest weekly percentage drop since mid-July. Even investors are selling dollars at the fastest rate available. What could we possibly expect from this current economy? Should we be rest assured as the government propagates, or be wary and keep preparing as Schiff claims? It's a split decision now. Let me know your thoughts in the comments section below. If you found this video insightful, don't forget to like and subscribe to my channel for more videos like this. See you in the next one.